Welcome, everyone. Today, we're going to talk about the world famous Starbucks coffee. This company is a great investment, I think, for the future and has proven to be a great investment over the past few years. We're going to dive into the recent controversies, which have kind of brought the price down recently and allowed us a good buying opportunity, in my opinion. Additionally, we're going to break down why I think that the stock will be a great stock to hold going forward. With that being said, my name is Jacob Braun. I'm the host of this weekly Monday night, 5 p.m. Eastern time episode. I'm a contributor for Seeking Alpha as well as writing as here. And I'm so glad that you came to join our show tonight. I'm going to quickly share my screen and then we can get started looking at our stuff. If you want to see more information about what I do or how you can find me, check out my Twitter at Real Jacob Braun. I have it pulled up right here. Now, Starbucks Corporation, we're using stockcard.io, an AI tool to look at companies here, which is a great tool that I use in my toolbox of investing. You can see it has different opinions. So it has very strong operations. Their revenue's been killing it, but their growth is a little bit limited. They're a massive corporation already. The biggest growth market left is China, and China has its own regulatory problems. Overall, investors are very pessimistic, and that's why we have a buying opportunity potentially with the stock staying right above its 52-week low. Fairly priced stock. The PE is sitting about 26. So that's not a bad PE, and that's a PE pricing a little bit more for growth. So if the company can still grow quite a bit, that's a good PE. Overall, I would love to see that PE drop just a little bit more and get a really good buying price. The stock is underperforming the market. It's had a bad little stretch here because of some recent news. Specifically, there's unionization efforts in stores, and the CEO recently had to resign. So those two things are very big issues for the company, but they're short-term issues, in my opinion. I think the company will be able to get through them and get back onto their track. Overall, you don't see any sell order from analysts, and overall, analysts are very positive about the stock. If we look at the chart, the 1-year chart, we're down 19%. The year-to-date chart, we're down about 25%. So we've greatly underperformed the market. It's not done great. If you look at the 52-week chart, this is what I like. So the analyst targets are all sitting with good upside, about a 50% upside, and we're sitting at well below our 52-week high, just above that 52-week low. Again, I believe that we've had a buying opportunity presented to us because of the turmoil around the company. I will need to see the company handle that turmoil. Right now, Howard Schultz, one of the big first CEO of the company, the CEO who really helped grow the company, is stepping in as an interim role. This is his third time as CEO, so he knows the company very well. I believe he's the company's largest shareholder. So they're going to go back to guided hands. But the thing is, he's obviously made it known that he doesn't want to be the CEO long term. That's why he isn't the CEO. He wasn't the CEO before. So the question is, will they be able to find another leader who will be able to continue to propel them forward? Additionally, touching on the unionization concerns, that's a very touchy situation. It's kind of a you lose situation. If the unionization doesn't go through, then you're going to see some political uproar. If the unionization does go through, it's going to really hurt the company in the short term's bottom line. So I think that's a very short term, bad public opinion topic. But once we get through that, we're going to be in a much better position. So overall, if we look at the stock, right, we're at a very attractive price. We're staying right above that 52-week low. The stock overall over the last, let's look at the historic performance. It's done an incredible performance over the last 10 years. It's returned over 10% every single year, beating the market over that 10-year stretch. So it's a great company. Dividend wise, we're sitting at a great dividend. We're sitting at a 2.15% dividend, which is better than the S&P 500, a little bit below some of those big dividend companies you see. One thing is the company, in addition to dividend, does share buybacks. So a share buyback helps increase the value of your share as well. Overall, so this company is not a dividend aristocrat because the company is so new. The company has had a great track record with dividends, consistently growing them and consistently paying them. So with Starbucks having such a cult-like following and such a big company, I think there will not be an issue about touching that dividend. And right now, with that lower price, you're actually it's just allowing you to get a better dividend yield on your shares. So I think that this company has a good dividend play and will be a good long-term, a little bit more stable, big blue chip company. Now I'm going to jump over to my next video segment, which is a more in-depth dive into the numbers. So one thing I want to touch on first is the risks the company faces. So outside the big risks that are the whole market with the global uncertainties with the Russian-Ukraine war, and inflation and whatnot, coffee actually faces a harder inflation than a lot of other industries. The price of a coffee bean rose 80% in the year of 2021, which is much higher than almost any other category. I think used cars got the big headline and they rose 50%. So coffee rose even more than that. One of the creators on YouTube, Graham Stephan, he created a great video going down and breaking down his personal coffee company and the expenses they face because of the high inflation on coffee beans. So if you want to learn more about the specifics, I would highly recommend looking at him and his video on his coffee company. But overall, Starbucks has faced higher costs on their coffee beans. So what they have to do is either decrease their margins, which would make them lose money, or lose profit, or they have to increase their prices. Either one is not ideal, but it seems that consumers are very willing to accept the higher inflation just because everything is in a high inflation environment. So that's not a great thing, but it's something that the company has to deal with. I'm going to quickly share my screen and we're going to look more at specifics of the company. One thing I love this revenue chart. So you can see where COVID hit. It's a clear dip, but what's incredible about their revenue is that, yes, there's a dip because of COVID, but it quickly jumps back to that original trend line, which is exactly what I want to see. It was affected by COVID, but it recovered great from COVID. And that revenue is expected to grow 10% year on year. That's what most analysts are projecting. The earnings per share of the company, this is a little bit more shaky, and that's because different quarters have different factors. But overall, we see a very good positive uptrend, and that's something we want to see. And that's expected to grow 12% year on year. Coming back to the main screen here. So the outstanding shares have decreased by 24% since the company's inception. So that just shows you how devoted the company is to share buybacks. So share buybacks are giving you value outside of the dividend that you don't even see. And that's going to help project the share price up in the future. Right now, we're sitting about 30% below the all-time high. And I would not be surprised if we hit it again once we get in a better market environment and once the company figures out the uncertainties surrounding it. Additionally, 50% of its earnings are paid in dividends. Like I said, it's got a great dividend history of consistently increasing its dividend and consistently paying it over the past 11 years when they first started paying a dividend. I would expect this company to eventually hopefully be a dividend aristocrat just because of their great dividend track record so far. But with 50% of their dividend, of their earnings per share being paid out as a dividend, and that earnings per share expected to grow, about 12% for most analysts think. So we would expect the dividend to grow about 12%. So this company is going to become a real great dividend player long term. And I think that's another reason I like investing in it. One, it's a very stable, big blue chip company, and it has some growth potential, but it also is a very good dividend payer. And that's very valuable to so many investors. Another cool thing is the company's membership grew 20% in Q4 to 26 million active users. So the membership program was started a few years ago after a downturn, and it really just helps reward customers to keep coming back. And this is what's I think has really helped contribute to their cult-like following. And I think most people would say that Starbucks has a cult-like following, which is what is incredible as a business model if you want to be successful. They have stores across the country, across the world, that all produce a consistent product and have people continually coming back. And that is what it allows them to have such a solid revenue base. Additionally, 55 100 of their 34,000 stores are in China. China's a massive market, as we all know, and China offers a lot of growth. So the company is slowly starting to expand it to China and overseas because they've expanded so much over the years in the United States that they're starting to run out of room to grow. But once you see they run out of places to grow with the stores, they can also grow their beverage line, which is seeing considerable growth. That's the line of products you see in stores, or you see, maybe even at restaurants or hotels. So the company's done a very good job of monetizing its brand, and it's just expanding revenue streams. Overall, I think the company's growing really well. I think that dividend is going to be a consistent dividend that's going to continue to grow. I really like this company because one, is stable, but two, is I think it'll be a consistent grower with a high dividend. So one thing is if you find a company with a good dividend, but it just stays steady or it doesn't grow. The ideal is you get a company with a good dividend that also has growth in it, because then you get both capital appreciation and your dividend, which can be used whether in drip to reinvest or can be used just for whatever you want. So I think that Starbucks is going to be a very good long-term play, and is definitely a company I will be watching. With that, thank you for watching, and I hope you enjoyed the video. If you have anything you want to reach out to me about, reach out to me on Twitter at RealJacobRaw. Have a good day.